right? We're just going to keep it simple, very simple, right? We're not talking about the actual underlying factors that cause market reversal, but I'm giving you something, that's very, very close, that is easy to understand. So once you understand this, whenever we dig deep into the information, which, you will not find within the charts, right? Then it will be easier to understand, right? But for now, what do you focus on? Interest rate trades, like you pay attention to them. There are times when price will expand a bit or drop a bit, whatever it may be, whatever it might do. The interest rate trades rarely, form sequential SMT. And the reason for that is because they reflect upon the information from the Forex market or the FX triad, which you already know what that is, right? The XYEUGU. They also reflect upon the index futures triad, right? So far, we are, focusing on 9 markets at the same time, which is unheard of. It's like you need to focus on one market. No, you need to focus on all of these markets because they're connected. It's like gears, right? They affect one another. When the interest rate triad does something, it affects the Forex market. And whatever the Forex market does, that will affect the index futures, which will affect the stock market, which will affect the cryptocurrency market, right? And that's what it is. This is why price moves. This is why price turns around. This is why price consolidates. There is no other factor which will give you, more precision. Well, there is. But we will get into that as we, go along. Look at the expansion that happened today within the interest rate triad, right? Look at the fluctuations that we had within the Forex market. Look at the fluctuations we had within the stock market and the index markets, the interest, right? Look at that. Why did that happen? There were no news events, right? Currently, ICT says don't trade here, don't trade here. So here is something, right, that he will never tell you. You will never know this. I don't even know if he knows this. He probably does and just doesn't want to tell us. Right? I'm not really sure anymore. But, here it is. On the days when you don't see, right, news events, which market do you expect to be the most probable? That's something that has never been talked about before. We must understand that price isn't random. There's no mistake that, causes a consolidation or expansion, right? That doesn't exist. Not here. It's an algorithm. It follows its rules. It does what it's supposed to do when it's supposed to do it. And the when is really important. So on these days right here, right, which, currently we're it's Tuesday. Tuesday's about to be over. Then we're going to go into Wednesday tomorrow, where we will see a great amount of volatility. Thursday as well, right? So do you guys remember from Sunday's analysis, everything that I said right here, right? We can see the price took out this low, which was the low of the previous week, right? So price took this low out and expanded upwards, right? Our draw on liquidity was this high right here, which we have seen price trade below this low, expand, retrace, formed a fair value gap. And you're going to learn something new now, right? So pay attention. This is for those who are, trying to learn, trying to pay attention, the ones that just want to become crazy. You won't learn this anywhere else. And it won't make sense to anyone else either. And it's literally just the tip of the iceberg. Most won't be able to understand. Right? Crosshairs on. Here we go. So you can see that here, this low right here, right, is the low that led the expansion leg upwards. And before even, going into that, do you remember, I want to see in the chat, do you guys remember what we talked about? Do you remember when we talked about the interest rate market trade? What do we expect? What do we expect? This is exactly what we expected. We expected this low right here, right? And when focusing on the interest rate market, right, we got to pay more attention to the T-bond futures, right, more than anything else. Second to the T-bond futures is the 10-year, right, the 10-year notes. We expected price to take the liquidity here and expand. And why did we expect price to expand afterwards? It was, all because of time. Why? This is the second week of the month, right? We took out the previous week's low. So what happens here? This becomes sequential SMT, right? And what solidified this? And you can see the solidification right here without even, going here or here, which you can see it right here as well. But there are other factors that you can, factor in, right? So here, this is where you will see the intermarket sequential SMT, right? Which, suggests higher prices once this low wasn't taken out. And the swing low formed here. This one took out this low, right? Here you can see they all took out the lows. So if you were just focusing on this market or this triad, you would not see that we had sequential SMT, right? Also, right, something that is important, right? So for this, I have to turn the crosshair on. So on this candle right here, right, you can see that there was a formation of a fair value gap. Right? But this is not a regular fair value gap, right? This is actually, the fair value gap that Michael taught. Was it last year or the year before? I don't really 100% remember what he called it, but it occurs when, wicks overlap, right? The implied fair value gap, that's what it is. Right, so here we had a implied fair value gap form, And price did not trade into the open of this candle, but it traded into the wick or near the wick. Afterwards, price expanded, close here, and once price opened here, you wouldn't expect price to go below this wick. And why is that? First of all, we had intermarket sequence or SMT, right? Here, we had price trade into the open of this candle. Well, this did not. So let me show you again. Listen, we have a lot of, cracking correlations that we haven't even touched on yet. Right, so here, right, price didn't trade into this, but it formed the implied fair value gap, which is right where price reacted to right here. See? This down close candle, price expanded, failed to trade into it. Here, right, we had price trading into it. This one, right? And remember, whenever you're trading, the best markets to trade will be, for example, if you like bonds, treasury notes, you want to trade that, which you can. You want to focus on, trading the T-bond futures and the 10-year note, right? These markets will react more, right? But the one in the middle, which you will always see, will be the best market to trade. So even though this expanded more, this would be, give you the most accuracy. But due to the fact that price traded here, failed to trade into the down close candle right here, expanded. On this candle right here, where you see price fail to reach here, right? And once this one trades here again, then you could be a buyer. Also, what else happens here? This down close candle right here, and remember, we're on the 4-hour time frame and the 4-hour time frame, and we're working within the monthly cycle now. Right? This down close candle right here is below the previous low. This one is above the previous low. Right? Which is why price failed to trade into this candle. Well, into this candle's open. And we had expansion afterwards. Right? Pay attention. Remember, as you guys realize, we're not really, this is like the Dow of the interest rate triads, right? We don't really trade the Dow. We don't really trade the Dow. We just use it because it has, certain attributes that we need to take into consideration. Right? So here you can see that we failed to trade into this candle. Here you can see that we trade into this candle's open. And here you can see that we trade into this candle's close. Then expanded a bit. And again, the most important thing to understand is this isn't random. We talked about this before it happened. Again, you know how long we've been doing this? It's insane. And it doesn't make any sense. We shouldn't be able to be doing this at all. This should be impossible. But here we are. If you can see, you will understand what I'm talking about. If you can't, then you just need to watch it again. Back test. And even after we're finished this year, I still believe that we will be barely brushing the surface. And Why is that? Do I not want to tell you everything? Of course I do. But if I tell you everything in a video, I'll probably be talking for weeks and then and that's not humanly possible. Right? I will just be it will be like me just introducing intermarket sequential SMT without even talking about quarterly theory. And just trying to talk and just trying to talk about it, and what would happen then? You wouldn't understand. So I have to give you bite-sized amount of information. So as you guys can see here, if you're interested in bonds or treasury notes, whatever, the T-bond features on the 10-year note will always deliver the better price action compared to the 5-year T note. Whenever you have this one delivering better price action than these, then these two will usually be in a tight range. And this will be just auto control going against whatever these two are doing, which is why you usually have the Dow doing whatever is happening here. So here you guys can see we have this, choppy price action, right, within the Forex triad. So first of all, right, we expected price to take this high, this low in regards to the US dollar index. That happened. This high in regards to the Great British Pound. It happened. But before, price traded here, what happened exactly? Right? So even within, low probability markets, this is low probability markets. Even though we got the direction or the short-term direction right, it was still low probability. And due to the fact that tomorrow's CPI, I currently have no bias. I'm just waiting for, CPI to happen. Or if there is sequential SMT between two sessions, then I will expect CPI to respect, whatever order flow that would suggest. Right? So here, I already showed you guys this, I believe. Right? So we had sequential SMT here, right? And right, we took out this low. I think I already posted this, but I'll do it again. And we failed to take out the high in the US dollar. And this all occurred on Monday. So here we traded here, failed to take this high out, broke down, right? There was no displacement, but we still had sequential SMT again here, which is when we would expect expansion, right? In the opposite direction of, the sequential SMT. Here we took this low, right? Then what happened afterwards? We had sequential SMT again, expanded. Even the high right here, right? This is a precision swing point. Right? This is a precision swing point right here. Price fell. Even here we had sequential SMT. Right, but this was intermarket, which occurred between the Asian session on the London session here. So as you guys can see, the markets are just, or the trades. The trades are, absolutely always, which other word could I use? Constantly reflecting upon each other. So the comparison between the interest rate market and the forex market, or the interest rate market and the index futures market is, very important to take into consideration. And you need to understand this, which we will probably be in this for, until, it's very clear to everyone, because like this is usually something that's hard to understand. I've taught people before, which are, currently amazing traders, analysts. But you need to understand this part. Like this part is the important part, right? Yes, there are trials for grains, commodities, metals, even the energy market. All of them. Because this is the market, right? Cotton has its own specific trend. Even orange juice. But we can't give you all of that information now, because that will, have you focusing on something that you shouldn't be focusing on right now. First, you need to understand this that's in front of you. And it's like insane. Like even right now, I'm looking at the precision swing point right here. It was literally the high of today, right? And literally before, you can't find this in a book. Like, how Michael will be like, you can't find this in a book. You can find my favorite book in a book, or my other book in a book. But you'll find in Larry Williams' book. You can't find this in a book. Actually, you literally cannot. You literally cannot find this in a book, right? This is impossible to find in a book. Right? You cannot. It's impossible. You can. You will not find this in a book. You need to you should search for it, try to find it, but it won't happen, right? This is because the thing that I focus on the most is time. So when I go through my charts, I look for, specific things that are out of line among a correlated group of assets during a specific time. And this is how I come to the conclusion of these things. Right? Even here, you can see this candle right here and the Great British Pound, right? That rallied. It was a up close candle. Look at the candle right here in the euro. It was an up close candle as well. No, it was a down close candle. My bad. Right, so you have a down close candle here and an up close candle here. What's that? A precision swing point. It's literally there. And it's amazing. So the low right here is a precision swing point. The high right here is a precision swing point as well. No one talks about this. No one has talked about this before. Literally. It's not like, when people say there's nothing new under the sun. That's true. There were swing points before, forever. People always talked about swing points, but no one talked about precision swing points, which is literally the tip of the iceberg, right? Because there are more questions to be answered, right? Okay, precision swing points alone I wouldn't say they don't mean anything, they do. But, right, when do you have, that precision swing point that just rarely fails? When? When do you have that precision swing point that expands? Okay, I already did this. So so this right here is a new week opening gap, right? And you can see that the precision swing point formed on the new week opening gap right here. So literally, once you saw this close up, this close down, you could expect, right, some sort of reversal with within the 65-70% range of probability. By just looking at this is just like 2 data points. Literally. But yet tomorrow we will be, reflecting upon whatever CPI does. We will be, obviously sharing if the market provides a setup that's high probability, we'll be sharing that. Of course we will. Right. And until then, just wait until CPI. It will be in less than 12 hours from now. Right. So yeah. I will be back with you guys tomorrow, as I should be. Tomorrow is Wednesday. It is. Yeah. So tomorrow, 6 p.m. Eastern Standard Time. And I hope that you guys, took something from tonight. Tried to give you guys, as much information as I possibly could with your, that your current understanding would, process correctly. But yeah, hope that you guys have a wonderful night. I'll be probably not heading to bed right now. Do some light back testing, continue to work on the algorithm, probably read a book, buy a house, I don't know. Yeah, have a wonderful night, everyone, and I'll see you guys tomorrow. Well, I'll talk to you guys tomorrow. I'm terrible at speaking, but I try. Please forgive me. Good night.